How to calculate property depreciation for financial statements. Have you ever wondered how property managers determine the value of their assets over time? Understanding how to calculate property depreciation is essential for accurate financial statements. Let's break it down step by step. First, you need to determine the asset cost. This includes the purchase price and any additional costs necessary to prepare the property for use. Think about legal fees and renovation costs that might have been incurred. Next, estimate the salvage value, also known as the residual value. This is the amount you expect to recover when the property is sold at the end of its useful life. For many properties, this value may be minimal or based on the land value. Now, let's talk about estimating the useful life of the property. This is the period during which the property is expected to generate economic benefits. For buildings, this typically ranges from 20 to 40 years, depending on factors like construction quality and usage. Once you have that information, you can choose a depreciation method. The straight-line method is the most common. Here's how it works. Depreciation expense equals the cost minus the salvage value divided by the useful life. This method spreads the expense evenly over the asset's useful life, making it straightforward for property management. Another option is the double declining balance method. This is an accelerated method where more depreciation is recognized in the early years. The formula is depreciation expense equals the beginning book value multiplied by 2 divided by the useful life. This method is useful if the property loses value quickly at the start. You can also consider the units of production method. This method bases depreciation on actual usage rather than time. The formula here is depreciation expense equals the cost minus the salvage value divided by total estimated units multiplied by units used in the period. This method is less common for properties but can apply to specialized assets. After selecting a method, calculate the annual depreciation expense for each accounting period, which is usually done annually. Finally, you will record the depreciation in your financial statements. The depreciation expense reduces the asset's book value on the balance sheet and is recorded as an expense on the income statement. This affects net income but does not impact cash flow. For urban property managers, here are some practical tips. Using the straight-line method is often the simplest choice unless there is a clear reason to choose an accelerated method. Keep detailed records of the asset's cost, improvements, and estimated useful life to ensure accurate calculations. Review and adjust your useful life estimates periodically to reflect any changes in property condition or market factors. Remember to separate land value from building value, as land is not depreciable. Lastly, consider local accounting standards and tax regulations, as they may specify allowable methods and useful life estimates. By following these steps, property managers can accurately reflect property depreciation in their financial statements, which is essential for budgeting, tax reporting, and financial analysis.